Disney stock just reported earnings and the stock fell another 7.8%. The company is now down 45% from its March 2021 high, and we basically have a decade of no returns for Disney investors. If you're involved in the culture wars, you may be saying, oh, simply get woke, go broke. But the real story is much more interesting and has to do with the shifting media landscape. This fiscal year, the Walt Disney Company generated record operating cash flow of $18.1 billion, plus its highest free cash flow ever at just over $10 billion. That is a $9 billion increase in the past 3 years. Bob Iger was brought back to return as CEO at the end of 2022 to try and return the company to its former economic strength. The pandemic plus the shift to streaming absolutely destroyed their profitability. In fiscal 2022, the direct-to-consumer streaming services lost $4 billion that year, and they were getting worse. In Q4, it hit $1.4 billion of losses. At the end of fiscal 2025, that has completely turned around and actually generated $1.3 billion of profit this year. That's expected to continue growing at a high rate as well. So the financial turnaround at the Walt Disney Company has been working, so much so that they announced $7 billion in share repurchases for next year, which is a double from their 2025 repurchases, and they announced a 50% increase to their semi-annual dividend. So why is Disney stock performance still terrible? Today I'm going to give you my analysis on just that, and I'll break down the latest earnings report for Disney stock, the good, the bad, and the ugly. With that said, let's roll the intro and get into the video.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using dividenddata.com, which is the best stock research tool. You can get 30 plus years of stock financials with pro data visualizations. And right now is the best time to join because we just started our Black Friday sale where you can get 50% off annual membership and you can lock in that discount for life. There's no risk in trying it out. There's a 30-day money-back guarantee. So use the link in the description and pin comment if you want to follow along. All right, so before I get into the latest earnings news, let's just take a big picture look at Disney stock. Now, this is hot off the presses, so the dividend increase is not yet reflected, but the forward-looking annual dividend will be $1.50 now. So that will be about a 1.4% forward-looking dividend yield. And based on EPS over the trailing 12 months, the current PE ratio is 16.8. So in today's market, that's definitely on the cheaper side. As I mentioned earlier, they have been growing their earnings per share coming out of 2021 and 2022. Analysts are expecting continued earnings per share growth in the coming years. That's 11% in 2026, 12 in 2027, and 10 in 2028. That means if you bought Disney stock today based on 2029's expected earnings, it would be a 12.2 P ratio. And by the way, in the outlook they just gave on their earnings call, they back up the expectations for double-digit earnings per share growth. So these actually might be a little bit conservative, these estimates. Overall, the consensus price target among Wall Street analysts for Disney stock is $136. That implies the stock is just under 27% undervalued. And the lowest price target on Wall Street is actually $130. In case you're wondering, the current stock price is $107. Historically, Disney used to be a dividend growth stock, but they've had a pretty weird past. They had a quarterly dividend for a long time with annual increases. Then they switched to annual dividends and they did annual increases with that one. Then they switched to semi-annual and started increasing it there. And then they completely suspended their dividend in the pandemic because more than half their business was shut down. And they also opened the money pit that became the direct-to-consumer streaming services. But since Bob Iger came back and started to fix the financial picture of Disney, they have started growing their dividend payment again. And they just announced another 50% dividend increase. And they have plenty of room to do this as well because the prior dividend based on last year's earnings was a 17% free cash flow payout ratio and 14% earnings per share payout ratio. So as I mentioned at the top of the video, the actual cash generation of Disney is very strong right now. So as we look at some of the key metrics for Disney stock, the revenue, so the top line money the company is bringing in, That growth actually is not as impressive as what they've been able to do on the bottom line lately because the costs were insanely inflated at this company. The 10-year compound annual growth rate for Disney revenue is 5.39%. And in the latest fiscal year, their revenue per share grew at 4.56%. Disney's net income, which uses GAAP accounting, that has grown at a 3-year compound annual growth rate of 58.52%, and it is nearly up to its all-time high in net income per share. If you're wondering what the earnings yield is for Disney stock right now, it's 6.06%. And again, that's a 16.5 PE ratio. If we look at the free cash flow per share for Disney stock, it's grown at a 5-year compound annual growth rate of 22.94% and a 112% CAGR over the past 3 years. In fiscal 2025, they increased free cash flow per share by 19.11%. And although they hit a record free cash flow in terms of raw dollar amounts, on a per share basis, it is still less than 2018 because they had the Fox acquisition. At the time, that was one of the biggest media acquisitions of all time. And you could argue it is actually Bob Iger's worst acquisition in terms of the valuations of those media assets came down significantly in the following years. But at the same time, you could argue that without those assets, their launch into streaming may not have been as successful. As you can see here in 2019, their shares outstanding jumped up a bunch, but this is set to decline as they have started share repurchases, and they just announced they will be doubling that share repurchase program. So that was a pretty good look into the financial picture of the Disney company. But now let's dive into the specific earnings report that just came out. To do so, I'll be using our partner Earnings Hub, which is available on the Dividend Data sidebar for our website. Just click Earnings Calendar, and it lets you see all the stocks reporting earnings. If you want access to Earnings Hub, the link's in the description and pinned comment of the video. Make sure to use that link and create an account so they know we sent you. So as you can see, Disney just reported before market open on Thursday. And here's a brief summary of the results. They beat on earnings per share compared to expectations. EPS for the quarter came in at $1.11, which was above the expectations by 7.7%. However, revenue came in below by 1.5% at $22.4 billion. By the way, Earnings Hub has become one of my go-to platforms for listening to earnings calls because you can get it all in one simple view. They also have a mobile app, so if you're on the go, it's a great way to listen to earnings calls. And I did listen to this Disney call prior to recording this video, so I had some great context for you guys. Now, it should be noted for that this specific quarter, that $1.11 earnings per share is actually down from the year prior at $1.14. That's a pretty negligible decline, and the trend overall is towards growth. So I already covered a lot of the financial performance from the latest quarter, and it was good. But really what matters is they gave outlook for the future years of the Walt Disney Company. They gave a huge breakdown for fiscal year 2026 and the next quarter. But I'm going to scroll down into what I think is the most important thing, which is that they're expecting double-digit earnings per share growth compared to fiscal year 2025, $19 billion in cash from operations, $9 billion of CapEx, so it will be another year of $10 billion of free cash flow. They're doubling share repurchases to $7 billion, and they announced a 50% increase to the semi-annual dividend. And by the way, in a little bit, I'll play a clip from the CFO of Disney who was on CNBC earlier today. He gave a great breakdown of how they're thinking about returning capital to shareholders. They also announced that for fiscal year 2027, they're expecting double-digit adjusted earnings per share growth compared to 2026. So 2 years of EPS growth above 10%. All right, so you might be saying, Zach, you're being way too positive here. Let's get to the negatives. I'm going to get to the negatives right now. First negative, top-line revenue growth sucks at this company. And there's a few reasons why. For this quarter, year over year, 0% growth. It actually went down slightly. For the full year 2025, it was up 3%. And a lot of that has to do with their entertainment business segment, which is the largest one in terms of revenue. That includes their DTC streaming business. But the declining part, as I will soon explain, is their legacy linear television business. That means cable channels. That legacy business is facing a lot of disruption. It also impacts their sports business. Much lower revenue, but it's actually much higher margin relative to the revenue. And then, of course, you have experiences, which is all the Disney parks. That's a huge part of their business that really differentiates them from a lot of the other media companies, like Netflix as an example. In 2025, that generated just under $10 billion of operating income, up 8% year over year. Let's stick on the negatives and dive into that entertainment segment. As you can see, operating income for that quarter went down 35% year over year. And linear networks is a declining business. There's no doubt about it. It's impacting every single media valuation from all the big media companies, whether it's Warner Bros. Discovery or Paramount. Revenue for the quarter declined 16% year over year. Overall, it was a 12% decrease for the full year. And the reason why this matters is that historically, this has been a big profit driver for the company, and it's declining every single year, and it will continue to decline. Operating income for linear networks declined 14% year over year for the full year and 21% year over year for the quarter. And despite great performance in direct-to-consumer with a 39% increase year over year in the quarter and more than 100% year over year for the full year, look at that. We went from $143 million to $1.3 billion of operating income. So linear networks in terms of operating income for the full year of 2025 was still more than double the direct-to-consumer profits. And I suspect that Disney stock will be in trouble as long as that's the case. Investors hate declining businesses, especially if they're a big percentage of a business. Disney needs a reset in the narrative, and people need to think of them as a growth business. So until the direct-to-consumer business becomes far more profitable than linear networks, Disney stock will probably still be in this limbo period. But if this quarter is an indication of something, it's getting closer. We're less than $50 million away in the quarter. And in terms of revenue, direct-to-consumer is already significantly larger than linear networks. $24.6 billion for the full year compared to $9.3 billion in linear networks for the full year. Now, what's interesting is that top-line growth for direct-to-consumer hasn't been that great either. 8% year over year is still pretty good growth, but it's nothing compared to what they've been able to do in terms of profitability. They have been able to wipe tons of cost structure out of that business. For a while, they were operating it like they were lighting money on fire. Now, what's interesting is that in the guidance and in the interview with the CFO and the earnings call, they mentioned that they expect direct-to-consumer revenue to accelerate and hit double-digit growth in the coming years. And that's what they need. They need direct-to-consumer to become a bigger and bigger chunk of the company so that the narrative changes. The bull case for Disney is if they start to get valued on a similar basis to a company like Netflix. Netflix is a pure streamer, and in terms of market cap is just under $500 billion. Disney's market cap is $190 billion. So Netflix is worth more than twice of what Disney is. Netflix trades at 48 times earnings. They trade at 12 times revenue, although the top line growth is much better at Netflix. Now, what's interesting is that Disney has much higher overall revenue, but that's partly due to their parks business and all the broader operations. And they generate more cash from operations and more free cash flow. But Netflix is worth much more because investors place a high multiple on that streaming business. And the reason why is it's a at-scale, gigantic membership subscription business. And there's a clear path to growth through adding more subscribers and raising prices. Netflix also has great usage, so they can grow that advertising business as well. So streaming can be a great business. And the interesting thing about Disney, which builds up the bull case, is that that same streaming business potential is within the shell that is Disney. And it's really just not being reflected in the valuation. And the problem if you're a Disney investor, you really have no idea when that will start happening. The market absolutely hates these legacy media businesses, despite how much intellectual property and content they own. They don't care about the cash flows the companies generate because a lot of that comes from declining business segments around linear television. As an example, Warner Bros. Discovery, that stock has been doing horrifically. It has only gone up recently because there are rumors of acquisitions, and Paramount Skydance has put in 3 offers, I'm pretty sure, to buy the company. Paramount Skydance, also a company whose stock has done terrible. The market absolutely hates these legacy media businesses, and they are right to do so. But there is a lot of value inside these assets that potentially could be reconfigured. Disney is really the closest to becoming a growth business for the future, and expectations are for every financial metric that it continues to grow on an overall basis. So Disney might be a good value play right now. And this is coming from someone who made a mistake with Disney stock in the past. I was buying it coming out of the 2020 pandemic because I saw the streaming future and that the parks were going to reopen and return to profitability. But then I started chasing it way too much because the streaming results were so good in terms of top line growth. But I really didn't factor in the profitability aspect because I was a newer investor at the time. And the transition to streaming completely killed the profits for Disney. I thought they were going to try a much leaner streaming strategy where they were just leveraging their assets rather than investing tens of billions of dollars a year into slop content for the service. But the financials are getting way better. And let's listen to what the CFO for Disney, Hugh Johnston, had to say on CNBC earlier today. This is the former CFO of PepsiCo as well. He's been with Disney for, I think, a year and a half now. I actually really like him. I think he's pretty good at his job.
Number one, DTC, terrific quarter. 12.5 million sub ads, 40% operating income growth, hit $1.3 billion this year compared to $100 million last year. And then the experiences business grew revenue 6% and grew operating income 13%. So overall, we're leaving the year with a lot of momentum, both on entertainment and on the experiences business. And as a result of that, we guided to double-digit EPS growth for the year, doubled the share repurchase, 50% increase in the dividend. Overall, we feel good about being what I refer to as an earnings compounder, and I think eventually investors are going to get conviction around that as well.
I know everyone's got questions at the table. What was the dividend choice, meaning to do this?
A number of things. Number one, obviously, when you commit to a dividend, that's a commitment forever. So it's awfully hard to cut the dividend unless some dramatic crisis happens. And we wanted to send a signal. Our cash flow is strong, and it's going to be strong for a sustained period of time. Same thing with share repurchase. To double the share repurchase to $7 billion, that's a signal that says, look, we expect cash flow not to be strong just for this year, but for a number of years going forward.
That's good news for the dividend-focused investors in Disney.
I mean, all the assets that you have seem to help each other. You build a brand, you put it in a theme park, you have great content from studios, you put it on streaming. All these things work perfectly. Yeah. You're at a $200 billion market cap, and Netflix is 500. Came out of nowhere with only streaming.
Yeah.
What does media look like? Why
Joe, I think you make a great point. As I just opened with, 19% EPS CAGR for 3 years says to me, we are an earnings compounder and we're a great cash generator. In addition to that, to your point about the Disney ecosystem, let's use Lilo and Stitch as an example. So it was $1 billion movie for it, biggest movie this year, Lilo and Stitch, looking phenomenally good. In addition to that, we put it on the streaming service, had 14 million views in 5 days. Right, so super content.
I mean, you're making a great case, but my point was, why is it down from a much higher levels?
Yeah, well, you have to take out.
Is it mispriced, the stock?
I believe it's underpriced. I really do. I believe investors are going to build conviction in it over time, and we actually see some investors doing that right now. But I think we need to continue to prove the case that, you know what, as we go through this transition, we are going to emerge one of the winners. In fact, we're already one of the winners.
So all those other things are additive. They're not a drag on.
No, I actually think quite the opposite. I think that integrated ecosystem works really, really well. This whole idea of splitting up assets and all that, that's when you do what you do when you don't have a great business.
Well,
when you have
Netflix
a great business,
is showing everyone, making everyone think differently.
Well, they've got a great business too, but they're very narrow, but they're deep on general entertainment. Our strategy is different. We run broad in terms of DTC. We have news, we have sports, we have broad-scale entertainment, kids entertainment. Who knows? Ultimately, on the service, you may see gaming and things like that as well. So I think it's basically the portal into all things Disney. And with the IP that we have, we're going to monetize it.
Intellectually, when I look at Disney stock, I kind of agree with you that it's mispriced. But at the same time, I don't see how in the next few months or year it's necessarily going to be doing much better. The market hates these other assets that Disney owns. At this point, they're basically assigning negative value to them, despite the fact that they generate billions of dollars a year. So it's interesting, if Disney stock continues to decline like it did today, 8.31% now, at a certain point, it just becomes an interesting value play. If you enjoyed this video, make sure to leave a like, comment, and subscribe to the channel. And if you want to use the tool I showed throughout the video, it's all available at dividenddata.com. We have our Black Friday sale going on right now, which is the best price we ever offer for the service. You can lock in 50% off annual membership, and you can keep that for life. The link is in the description and pinned comment of the video. Make sure to get it while it's available. With that said, thanks for watching, and I'll see you in the next video.